What is going on, guys? Obviously it's Jordan here, back again with another video, and today we're talking about how to invest as a 21-year-old or a 22-year-old or a student, a beginner, whatever box you want to put me in for the sake of this video. But it's basically just a lowdown of investing and kind of like the basic terms of like how to invest, and it's something that I think a lot of people need, a lot of people have been asking me for. So yeah, without further ado, let's get into it. For the first like 3 minutes, because I know that my view duration averages around 3 minutes, no matter what I do, I can even put out a 2 minute video and I'll still manage to get like 3 minutes of average view duration. So like for all you guys that are, around the average mark, that will tune out sooner rather than later, I think the most important thing I can probably start with would be like the how to invest. And fundamentally, if you're talking about the stock market, like the typical term for investing, you have to do it through a brokerage, be it like these bigger firms like Hargreaves Lansdown, Vanguard, AJ Bell, or if you're like, for most of us that are students that have a lower level of entry, there are loads of apps out there you can use like Moneybox, Free Trade, Nutmeg, Wealthify, and these places are just ways to, it's basically an access point into the stock market that allows you to go and trade and invest however you want. I think Vanguard and some of these places only allow you to invest using their own private funds, like the Vanguard fund or something. I've never actually used Vanguard. If you do want a video actually about like the best sources, let me know in the comments down below and I can do that for you. I can source out the best information. But I personally use Free Trade because they're free and you can start with like £1. So that's the best way that I personally recommend for most beginners that don't have loads of money out there. If you do happen to be like a high net worth individual or of like millions of pounds in the bank for whatever reason coming out of university, then I'd probably recommend like a portfolio manager or someone that can do all the work for you, because that way you're not eating too much into your profits, but you still get the best out of both worlds. Whereas if you're not making that much money, you're paying a lot for the manager to do the work, and you're probably not making much interest on on your money in the first place to justify that expense. But otherwise, yeah, in terms of like stock markets, that's the fundamentals. I would always say your tolerance should depend, should vary greatly on your budget. If you have a big budget, and when I say budget, I mean your discretionary income, not just all of your income. Make sure you know exactly what you're going to invest, and then that should determine your level of tolerance. Also your age. If you're young, you can afford to take risks. But all of that I'm going to explore in more depth throughout this video, so stick around and we're going to talk about that in more depth, as I said. But for the people that tick off around the 3 minute mark, that's the lowdown for you guys. But yeah, with that all kind of said, let's get into the actual nitty-gritty of the video. So we're going to talk mostly, I guess, about like stock market investing and the typical sense of investing. On that sense, we're talking more specifically about general capital gains or general capital growth. And what that means is you buy a stock at this price and then you sell out at that price, and that difference is what you profit. That's your your capital gains, and that's the general consensus. Some people can trade. Trading is a cool thing to do, but my experience is that trading is more your day-to-day, your day trader, your forex trader. And yeah, you can make millions that way, but the professionals out there literally have their whole career hinging on making money. And when I say making money, I mean like making something, not necessarily millions, but just actually making, staying in the black or in the green, whatever word you want to use. So if you're a typical, average person, I wouldn't really recommend the day trading route. It looks very glamorous and all glitzy and wow, millionaire, but it's not easy, and it's not something that I'd recommend. I'm personally a lot more of an investor. That's basically what I do now. And the key difference is obviously, as I said, trading to day, investing is your 5 to 10 year, your time in market as opposed to timing the market, and it's a lot more safe. It's a lot more, I don't want to say it's risk-free, because there's obviously going to be risk in any investment, but we're going to talk more about that throughout the video anyway. And again, yeah, investing is generally safer than trading in my experience. The whole point of this video, as I said, is we're going to talk about different ways to invest for beginners, and I'm going to go into depth about the four like main strategies, if you will. Well, they're not necessarily strategies, but you know what I mean. And it's like you have your risk tolerance, high and low risk, and then you have your reward appeal, I guess, your high and low reward. And we're going to find the four segments of this chart. So obviously, like the x-axis and the y-axis, like the base, the left, the first quadrant will be your low risk, low reward. Your fourth quadrant will be your high risk, high reward, and then we're going to go around as per. It's important to note, as I said, that investing in any capacity is always going to be long term. It's always going to be you're putting X into Y, and then Y will help you generate Z from X. And you're just hoping that Z is higher than, more valuable than that X was. So that could be money. You're putting in £10 into Tesla and expecting it to become 20, or it could be X could be yourself. You invest in yourself by buying a book, hoping that you come out knowing more. And it's all about, that bottom line, understanding where you want to go and what your risk tolerance is and your required output. It's important to make sure you have an emergency fund first, and again, to make sure you're investing only with discretionary income, not just all the money you have. Make sure you have your disposable income, you pay your bills and all that stuff, you have extra money you can afford to invest. And then before you do that, make sure you have an emergency fund, because that's so important, especially in days like this where people are struggling to get jobs and to maintain their jobs and stuff like that with all COVID and stuff going around. But yeah, let's start off by talking about the low risk, low reward category. So when we talk about low risk, low reward, obviously we're talking about things that aren't necessarily going to go up or down over a period of time. So generally speaking, we're talking about your high interest savings accounts, or we're talking about bonds. So high interest savings are generally split into two categories. You have your fixed income, your fixed interest rate savings accounts, or you have your variable rate. Fixed rate is pretty cool, but it means that you generally have to lock your money away for 1, 3, or 5 years, or sometimes it lets you deposit or withdraw money, within 48 hours or 24 hours. But usually if you're looking at the fixed interest rate, you're looking at locking your money away, which might not be good for some people. If you're saying, look, for 1 year, keep my money, and you're only really getting out like 1%, 2%, it's not the greatest. And to be fair, actually, if you guys want another video on the top paying interest accounts, let me know that as well in the description, in the comment section, and I can do the work for that as well. But fundamentally, most people, I think, most beginners, most young people will be looking at high interest savings accounts that are easy access, or variable rate. So typically you get lower rates there, but what that means is that you can add money in whenever you want, you can take money out whenever you want, and it also means the bank can change the interest rate over time. But they've done that recently as well with all this COVID, but it's like they give you a 3-month, 4-month window. They say, by the way, from July it's going to be 1%, 2%, and at that point, that's when you can think twice about your investments. But otherwise, it's no risk, because it's not really going anywhere, unless obviously your account gets hacked. But it's low risk, low reward, as I said. The other thing that I mentioned are bonds, and bonds are you typically get a government bond, or you can get a company bonds with some institutions. But it's effectively like an IOU or like a loan. You're kind of giving them money, and they're going to give you the money back plus some interest. And again, low risk, low reward, but it's safe, and you do typically have to lock that money away, in a sense that you give it to the government for a year and they give you a return. But again, if it were me and I could only go in the low risk, low reward category, because I don't know if you don't have much discretionary income, then yeah, I would go for the easy access savings account, high interest rate, and just kind of bank on that. But let's break out of the low risk, low reward category and talk about the complete opposite end of the spectrum, the high risk and the high reward that I know most guys came here for. So the first thing that you would typically expect to find in this box would be stocks, and that's specifically individual stocks. Personally, I don't recommend individual stocks. If you do desperately want to buy individual stocks, I would recommend tech. Even though this is not financial advice, I am not a financial investor advisor. Do your own research. This is for education and entertainment purposes only. But I recommend tech. All of the stocks that I own, all the individual stocks I own, are tech companies. But when you're investing in individual stocks, unless you do all the research, you're pretty much just gambling. You pretty much are just speculating on the long-term success, as opposed to actually being an investor. So don't get it twisted. You're not just an investor because you downloaded Robinhood and bought some Hertz shares. But yeah, I don't really recommend it unless you know what you're doing. But that's one way to make money, of course, buying individual stocks. The better way that most people do it, that I do it, is by buying into a fund. And a fund is essentially a ready-made diversified portfolio of investments where you buy into that fund, and your investment is distributed across fractions of all the companies within that fund. So you have mutual funds, which I think are pretty bad. They're quite old school. They're typically run by, I feel like I'm being attacked by the tree behind me. they're typically run by investment managers. So you invest into that fund, you effectively invest into those guys, and then they will go and actively buy different companies with the money that you've put into the fund. And that's a nice way to leverage your risk, of course, by like spreading your investment across many companies, and you're diversified. But because it's actively run by a bunch of portfolio managers, your fees are quite high. So what was introduced later on, which is what I use the most, are index funds, and then from that you have ETFs. But specifically, index funds are basically the same as a mutual fund, but it's a special element where it's like, instead of it being actively managed by portfolio managers, it's kind of managed by an index. It's like an algorithm effectively that effectively tracks a bunch of companies within that index. So you can hear about, for example, the S&P 500 or FTSE 100, FTSE 250. These index funds track the top 100 companies in the UK or the 500 in the US, and yeah, they track the performance over time, and it's all passive. So that's the main difference. Mutual funds are more active, index funds are more passive, and it means you don't have to pay for managers to do it for you. You just put the money there, and it gets distributed on its own. When it comes to ETFs, there's a big difference between, well, not a big difference, but one main sticking point for me at least, between an ETF and an index fund. And that's that an ETF behaves like a stock, in the sense that you can buy in at this price and sell in that price, and it's more flexible. But the problem is you're kind of doing an individual transaction each time you want to buy those ETF shares. Whereas an index fund, if you have your fund, you can reinvest for free without constantly repaying transaction fees and stuff like that. So that's the main difference. An ETF is more flexible, but an index fund, I think it works out cheaper if you're going to just keep putting more and more money in at random times. Like that automatic reinvestment it works out cheaper for an index fund. But yeah, I personally recommend index funds. Index funds pretty much always, almost literally always outperform these mutual. They outperform these like individual traders, these like stock portfolio managers, these hedge fund managers. Like, it's very, very hard to beat the market. And I think the specific percentage is like 97% of the time the market wins. So if you do want to buy individual stocks, again, based on what I just said, you do you. But the professionals aren't even beating these indexes most of the time. So, best of luck if that's the route you choose to take. I think the final point to note on funds in general, and whether you use mutual funds, index funds, or ETFs, is that if you do one that tracks like an S&P 500, for example, you're expecting like a 7% return pretty much. I mean, that's not to say that it's every year is going to be 7%, but you have some good months, some good years, some bad years, but the markets have never produced a negative result over a 20-year spread. And if you are going to invest in, as I said, S&P 500, FTSE 100, or some of the Vanguard funds, or whatever you decide to use, if you just get a relatively good diversified portfolio of like one or two of these funds to cover a nice amount of companies, you're typically going to expect about 7% return. That might look bleak in 2020, but I promise you, if you invest this year, in 20 years' time, you're most likely, based on historic data, going to be okay. Obviously, I don't know that. No one can look into the future. Things can happen at any point. But you're basically banking on capitalism, like surviving. Or like, if you bet on, for example, FTSE 100, you're basically betting on the UK economy to do okay. And you know how the Western world is. Anything can happen, but you'd expect GDP to be maintained. That's kind of our thing out here. The only issue, the only thing that people talk about when it comes to stocks versus funds, is that stocks, of course, you have all the control, but you also have to do all of the work. Whereas with an index, or with a fund, I should say, you have no control, but you don't do any of the work. So it's very easy, and you do just give them the money to do it, to handle it their own way, whether it's an algorithm or a person. But you don't have the control of, if Apple starts to do really well, you can't be like, oh, put more money into Apple doing really well right now. Whereas if you're doing individual stocks, you can just pick individual ones and make the money that way. But again, it's so much easier using an index, and index do usually win. However, as I mentioned, if you do want to invest in stocks, I recommend tech personally. Not financial advice, but yeah, you're asking for an uphill battle at that point. I should put an asterisk actually, because I did say high risk, high reward, but that high reward is of course attached to that high risk. Don't forget that. The markets can go down. So I want to drill this into your guys' heads that only invest with your discretionary income. Don't overinvest. Don't put yourself in a position where you need that money within the next year, 2 years, 3 years, 10 years, and have an emergency fund, because if you have the money aside and you know that whether this goes up or down, you're going to be okay, that can help alleviate some of the stress that comes attached to, behavioral economics, and you start to worry a lot, or you start to overinvest when things are up. And it's nice to get your head out of it and just to be logical. And the main method actually that I didn't mention is that this is what I do, and I think it's probably the best overall method anyway. It's called dollar cost averaging, where instead of like putting in 1 grand today, like all of your money in one day, you just consistently average your cost over the 12-month spread, the 24-month spread, and you put in like 200, 200, 200, 200, whether it's up, down, in the middle, wherever. And over the long run, dollar cost averaging, like statistically, is the best method. You do make the highest gains. If you want, again, this isn't financial advice, so feel free to put all your money into one stock if that's the way you want to do things. But dollar cost averaging, putting in money on the same day every month, over the course of a year, is way more effective statistically speaking, and it's just a better way to leverage your risk, I guess, to mitigate against massive dips or spikes in the market. So that's enough of that. The next category that I think is probably the most important, that maybe should have started with, but it's a low risk, high reward. Now I bet you guys are thinking that how can there be a whole category for this? Like, if there was something that was low risk, high reward, everyone would be doing it. But the fact of the matter is, there are some low risk, high reward things out there that I do a lot of all of the time, and some of you guys can learn from. So what out there is low risk, high reward? The first thing, and probably the most obvious thing, is a pension. I don't know how it works in the US, but in the UK, we have like the employer contribution scheme, which basically means if you put in, let's say, 9% of your income into your pension, your employer will match that to 11%. That way they put 20%, effectively 20% of your salary goes into your pension, and only 9% of that is yours, and the employer basically double your money. It's basically free money every year, tax free, into your pension fund. That, I mean, like come on, it's a no-brainer. It's a no-brainer, because everyone's going to retire at some point. If hopefully we will make it that far, but we're all going to retire at some point, and we're going to need money then. And if you're talking about long-term investments, if you're still in uni, or you're 20, 21 like me, 22 like me, then that is between 22 and like 70, let's just say 72 for the sake of maths. That's 50 years, 50 long years of guaranteed long-term growth if you just invest in your pension. So just be tactical about that. And also, as I said, the employer contribution is like just free money. Another thing you can do is an ISA, or I think in America it's like the Roth IRA, all these different accounts, but it's just a way to invest or to save even on a tax-free account. In the UK, we have a 20 grand ISA limit. That's an individual savings account, it's called, where you put your money into the ISA and then you invest through the ISA, or sometimes you can just have an ISA cash savings account. But we're talking about investing, so you put that into the ISA, you do have a cash or stocks and shares, and the 20 grand, the original 20 grand that you put in, is tax free. All the money you make from that, you don't pay any tax on it because it's done through the ISA. One special case is a lifetime ISA, and I can also compare, if you want another video on that, this is the third video suggestion, lifetime ISA versus Help to Buy, which isn't actually around anymore, but I know people have it. But the lifetime ISA is a different extension of the ISAs, and you only get a 4K limit, so it's a lot smaller per tax year. But the government then go on to add 25% bonus onto that 4K, and then you can invest that into stocks and shares if you want, or it can be a cash ISA, depending on how you want to do it. My trading account is done for a stocks and shares lifetime ISA, or a LISA, what I like to call it. So if I put in 4 grand in this tax year, and then the government add another grand, that's just 5K that I can gamble with, not gamble with, but I can invest, I can be tactical with. And the catch is that whole 4 grand, or everything in your lifetime ISA, the catch is that has to go towards a house, be it a deposit, a mortgage, a rent adjustment thing. But regardless, we're talking free money here, and at some point, pretty much all of us are going to need a house of our own as well one day. So that's another tactical way around it. And if you don't want a LISA, of course, you can just do a typical ISA, but that's a nice low risk, high reward. Because the reason why I say low risk is because you're not, it's an account. All you got to do is make this account and then you invest with it. So that's low risk, high reward to me. The other three things, one of them is, I was going to say real estate, but that's not really my field, my area of expertise. So I'm not going to talk about that in depth or at all, really. But investing in real estate is typically a low risk, high reward sector. Obviously, do your own research on it. I don't really know much about it myself, but that's in there. Investing in yourself is by far the lowest risk, highest reward activity out there. If you have £100, instead of putting that in the stock market, just buy some books, get intelligent, know what you're doing, invest in your business and advertising or something. Like anything you can do for yourself is pretty much no risk, because it's for you, and the reward can potentially be low if it's like a fictional book. You're not really learning how to invest from a fiction book, but I mean, you're still enlightening yourself, you're still learning from yourself, you're still being more articulate or literate, or like there are so many things you can do in terms of investing in yourself. And I don't just mean books, you can also travel, and I don't mean holidays, I mean like actual traveling, networking, increasing your cultural intelligence, even just going to the gym, or like buying vitamins, or having a balanced diet. Anything that's going to help you be the better version of yourself tomorrow than you are today, like that's an investment in yourself that is imperative. In fact, investing in yourself is by far the most important thing, even above having an emergency fund, because you need to be like in your best possible shape at all times, because health is wealth. And we're seeing that very clearly in 2020. But yeah, invest in yourself, that's low risk, high reward. And the final thing, that this is something that I can get behind so heavily, is flip. The flip life, the buying low, selling high of physical products in the real world. Going to boot sales, Facebook Marketplace, eBay. I was going to say Green. It's not called Green. It's Gumtree. That's the one. I don't Green because the logo, but you go to Gumtree, get stuff for cheap, free cycle, Craigslist, get stuff for free if you have to, and then resell it online for profit. That's the lowest possible risk. If you know what you're doing and you can see something that's clearly underpriced, be it like a Lego toy or a coin or something that is worth more, and you're like, why is this so cheap? Instead of saying, why is it so cheap, just saying, look, how much can I sell that for? And then buy it. You can go to someone's house on Gumtree, pick up a sofa for free, take it on your back on the bus or in the back of the car if you have one, sell it on eBay. Like there's literally, if you know what you're doing, no risk, because again, it's going to sell for profit. All you got to do is pick it up. And the thing is, most of the time, if you're doing it in real life, like in a boot sale or on Gumtree, you can go to their house. If you see that they sold you faulty products, just don't take it, or just don't give them the cash. Just be like, nah, and I'm not going to make money from this. Your listing was a lie or whatever. So you do have so much control there. And again, the risk, if you know what you're doing, if you get a good product, is effectively zero, and the reward is almost immeasurable, because it depends on what you pick up. I've seen someone get a PS4 on Facebook for free and sell it for like, £200-300. It's crazy how much you can make if you just look in the right places, and again, if you know what you're doing. Similar to that, you can do like affiliate marketing or things of that manner, where you just sell other people's products for commission or for a flat rate. That's also cool. I don't know too much about that myself, but that's a similar thread of no risk, high reward, because you're selling someone else's product. You don't have to do any work yourself other than make those ads. And yeah, effectively, those are the three quadrants that you should care about. That's essentially all of it. If you do want some high risk, low reward investment tactics, basically something that's very high risk, low reward is like buying stocks that someone has told you to buy without doing the research yourself, going outside without wearing a mask, high risk, low reward. You're not really getting anything out of it other than comfort, but you're risking, coronavirus, which is, as Cardi B put it, it's quite bad. Also, what else is there? But these courses you see online, yeah, I wouldn't. You have to be skeptical. When you see someone selling you a course, think about, are they really selling me a course, or are they just selling me their good marketing skills around something that I can get in a book for like £2? Most of the time, people just promote what they read in like Rich Dad Poor Dad, 4-Hour Work Week. The Secret is another book people just like read, and then they try and sell you a course on how to be financially independent. Yeah, $5,000 for my course, when you can literally just read the book and you'll be okay. And yeah, I mean, I can go on all day. There are so many bad ideas out there that might seem good on the outside, but typically it's low reward and you're risking quite a lot. So just try, invest in yourself, flip some things, invest in an index fund, do your own research yourself as well, and have a pension, have an emergency fund and all of that. that's basically it from my perspective. If there's anything I missed, let me know down in the comments below. As of right now, I'm worried my phone might overheat again, so I'm going to quickly wrap up and say thanks for watching. Don't forget to like, subscribe, comment. Obviously, as I mentioned, keep giving me more ideas of videos to come up with. And as of right now, that's it from me. Peace.